Welcome back to Face Luke. How are you?
Thanks for having me on, Dale. I'm doing great. How about yourself?
Pretty good, buddy. What's top of mind? Does midterms mean anything to you in your work?
Not really. I mean, it's interesting that the red wave was not as big as they thought, but not really.
Yeah,
Not really.
doesn't matter. The financial situation has been caused by both parties, right? So,
It's both parties, and to me, I continue to think by far the biggest news that I've been surprised people have not paid attention to was what Treasury said last Monday afternoon. Everyone was so focused on the Fed meeting that they missed what I thought was the biggest news for the next 6 months for markets, FX markets, risk markets, et cetera, which is Treasury quietly came out and implicitly doubled their estimate for the US deficit, federal deficit over the next 6 months. And they
okay,
put it in like it was in the Treasury borrowing update. And
okay,
it's so important because they came out and they said, all right, we're going to borrow 550 billion in the fourth quarter net. That's up 37% from 3 months earlier for their estimate for fourth quarter borrowing.
who's buying this debt right now, Luke? I mean, like I look at certain things like TLT, and I've been looking for a bear market rally for quite some time. It just can't deliver. I still think it's way overdone. But who's on the other side of this collapse? And really, does the U.S. Treasury market look any better than the gilt market does in the U.K.? Are we in the same type of situation, maybe just not as extreme as the gilt market?
We're in the same situation. It's not as extreme because we're the reserve currency and because you have the euro dollar market that creates some dollar demand that in sizes that doesn't exist for the sterling, but we also are orders of magnitude bigger in terms of the debt problem that the UK has. So there's puts and takes to it. So it's what it tells you is that tax receipts in the United States are collapsing in real time, right? That the fact that they're increasing. Now they called it fiscal developments. I think fiscal developments. I think they referred to it as tax receipts are collapsing as a
Okay.
result of the Fed hikes. And so you've got now not only did they increase the borrowing to 550 billion from 400 billion in 3 months, they initiated a 1Q23 estimate of borrowing, which was 578 billion net plus 200 billion in a rundown in the cash account, Treasury's cash account, the TGA. And so if you add the 200 back to the 578, you get 778. That's your proxy for what the deficit's going to be in the first quarter 23, according to Treasury. 778 plus 550 for 4Q. Next 6 months, we're going to be running a $1.33 trillion deficit over the next 6 months, which is roughly the size of the deficit of the past year. So you are running on an annualized basis a doubling of the deficit. And it's critical to markets because now we get a very binary decision. Is the Fed going to print the money to pay for it, or are they not? And if they don't, dollar's going up, risk is going down, everything else is going down. And within that context, the fact that gold is holding in the way it is increasingly interesting because Treasury, Fed are all now getting into a very dangerous game. Fed can tighten to fight inflation, but the second at some point, these markets are going to start getting concerned about fiscal sustainability in the United States. You had Larry Summers 2 weeks ago refer to a debt doom loop, and he's a former Treasury Secretary of the United States. I don't know what that number is.
Is that a synonym for sovereign debt crisis?
Absolutely. Okay. I think part of why the message to me of gold holding in so well with nominal rates rising the way they are, with real rates rising they are, is people are starting to do the math. The U.S. government can't afford the terminal rate. They can't afford the terminal rate that Eurodollar futures are predicting.
How much has interest expense increased in the last year with what has happened with rates, Luke?
Well, you
Has it
can.
doubled? Has
mm,
it?
it. The short answer is no. 24 trillion in debt. 28% of it's going to reprice in the next 12 months. So 28 times, say 30 times 24 is 720, 720 billion. Say it's up, I don't know, 300 bips year over year. So you're going to be, you're going to be up, whatever that works out to be, 100 billion, something like that. Or no, sorry, 100, yeah, 150, 200 billion, just on that part of the interest. But where the other things that are interesting, no one's doing the math. The cost of living increase in Social Security alone next year, it's going to be 120 billion. The Fed not remitting the money because the Fed is now upside down. It's 107 billion. So 107 plus 120, plus if we have a recession, which is increasingly looking likely, a 20%, a plain vanilla recession. Forget about a 2020 crisis. Forget about a 2008 crisis. Just a nice little plain vanilla 01, 91 type recession. You're going to get tax receipts down 20%. You get that tax receipts down 20% on 4.5 trillion in tax receipts. That's 900 billion. So like I can double the deficit next year without really even breaking a sweat. 900 billion plus 120 plus 107 plus call it 240 in interest. That's no enrollment gains from more boomers retiring, et cetera, et cetera. So now you have this funding problem. To your question, who's been buying it? The stronger the dollar get, the Japanese are sellers, Chinese are going to be sellers. The whole world's got 7.5 trillion in treasuries for sale to defend their currencies. They got to sell treasury. The treasuries are piggy bank, so they got to break the piggy bank to get the dollars to defend their currencies or to buy energy. It's sort of one and the same. So you've got Fed selling, treasuries at 95 billion a month. Well, selling duration, right? Portion of that's treasuries. You've got treasury selling treasuries, or they thought they were going to sell $1.3 trillion. Now they're going to sell 2.7, and that's assuming we don't get a nasty recession. That number in a nasty recession could easily be 3.5 trillion, maybe more. You've got foreigners, the dollars. If the Fed is not monetizing enough, if the Fed is not growing their balance sheet, dollar's going to go up and in a disorderly way. And as that happens, you're going to see foreigners, and they've got 7.5 trillion for sale. I mean, the global private sector's been buying treasuries. They've bought, I think, 650 or 700 billion year to date. The two biggest buyers of that are the UK and the Cayman Islands. Hedge funds
I heard
and
that.
hedge funds.
Yeah, the Caymans.
Now, the thing about hedge funds is they want to make money, and they want to make money on a monthly basis. And the problem there is as treasuries break down, they don't just sit there and hold them. They'll turn sellers. And so now your biggest private buyers, they're purely profit motivated, and they've got a monthly mandate. So they turn seller. So this thing to me could get extraordinarily disorderly in terms of the dollar on the upside and everything else on the downside in a very short period of time. So it was interesting when you said, I see S&P down, whatever that would work out to, 10% by the end of the month or something. That makes sense to me. You can look and see the Treasury General account has fallen about 100. It's a little over 100 billion, 120 billion over the last 6 weeks. So basically, I think to paint the tape for the election, Treasury's basically been sterilizing Fed QT and post-election.
Fed guy talks about some type of facility that the Fed may come up with to backstop bonds. To me, it's rocket science, what he talks about. Do you see them coming in with any type of measure to stabilize the bond market? Maybe
at some point, yeah. At these levels, no. I think you probably give back a lot of October's rally in equity markets first.
Okay.
And I think what the catalyst for that is a disorderly increase in yields, right? I think you have risk of the 10-year goes from 4.15 or wherever it is right now to 5.5 in 3 weeks, and you get something like that, and you go, oh God, then they're going to have to react, and CPI won't matter. The Fed's going to have to print money with CPI wherever it is at that day.
Well, this move in the dollar has been really, all it did was mark time. If it was going to be an important top, don't you think, Luke, we would have seen sharper breaks? And to me, it looks like you see this reading on RSI. I know it's technical, but markets rarely peak when momentum is confirming price. So even though I've been working the short side of the dollar, it just never, the process never gave me confidence. And I agree with you. I think there's something coming up going into year end that is going to drive the dollar to another high.
I agree. From a fundamental standpoint, this Treasury release would tell you exactly that's exactly it. Is someone's got to buy this debt, and the biggest marginal buyers are very price sensitive, which tell you rates are going higher, capital costs are going higher, dollar going higher, pretty much everything else going lower. I still like gold. I understand it probably marks time, but we're going to, at some point in the not too distant future, and we may already be at that point, I don't know, but gold is going to start going up with rates as people just do the math, which is U.S. government's, U.S. government is bankrupt without Fed help at, I don't know if it's 5 or 5.5 or 6 on Fed funds, but it ain't 10. It's well before 10.
And you mentioned I get your emails, Luke, the quality of the buyers and the quantity of gold that's being bought by these central banks. What were the numbers again? I mean, they're expanding dramatically the amount of gold they're taking down.
Yeah, it was really interesting. In the third quarter, World Gold Council came out and said third quarter central bank gold buying set an all-time record, which I think 400 tons in the quarter. Interestingly, 300 tons of it was undeclared, which is unusual. Who knows? But to me, the Chinese, the Russians, the Turks, or the people that have been, the nations and the central banks that have been pretty open about this, have been pretty open about it. I don't know why they would hide it. So to me, the fact that there was 300 tons bought in the third quarter, in the middle of the biggest dollar move higher, when there's this dollar shortage, while they're selling treasuries with both hands, is interesting. And then you say, okay, who would be buying a lot of gold that doesn't, at the central bank level, that might not want it announced? To me, there's 3 most likely candidates. It's the Germans, the Japanese, or the Saudis, all of which would probably not want to, if I don't think they'd want to alert markets to that yet, because I think if any of us woke up and saw a headline that the Saudis had bought 100 tons of gold, or the Japanese had bought 100 tons of gold, or the Germans ditto, that has major market implications for the dollar, for geopolitics, etc. So my guess is I think it might be one of those 3, but that's just spitballing. The bigger, more important picture is they're buying gold as they're selling treasuries in a dollar shortage and dollar tightness, as a time that real rates are rising rapidly. That's a play on this can't continue long. It's not sustainable, in my view.
Right, it's not an inflation play; it's a solvency play, isn't it?
It's a solvency of the global reserve currency issuer play. Yeah.
Okay, so I know a lot. You've talked about peak cheap energy, and peak cheap energy is definitely, even before the war, you were talking about this, Luke, and we've vacillated in this range between 80, 90. What does winter look like, and how does that exacerbate the global financial stress that we're currently seeing? Do you think that we're going to get another big run in energy over the winter? And
yes, I do. I do.
Okay.
You've run down the SPR, here too. I think the administration,
That was
it
a
is what
great
it is.
fade. Wasn't it a great break? Didn't Joe provide a great break to buy? That was a low for a very nice rally, but I appreciate when politicians give you breaks to buy. So what are we going to do if we need energy and there's a problem?
Energy going up is going to make this machinery all spin faster, because the bottom line is that it is going to push higher energy costs, push Japan, Europe, these major current in normal times, they're current account surplus nations, right? So they are recycling dollars into US financial markets. They are increasing their dollar asset piggy bank. When energy prices get too high, they need to buy energy because people don't like to be cold and they don't like to starve. And so energy is more important than the dollar. It's more important than treasury bonds. It's more important than other dollar assets. If oil, peak cheap energy, as we get into this winter, if I'm right, and oil prices, energy prices keep rising overall, it's going to accelerate the pace of foreign selling of treasury bonds. And a reminder, foreigners in total own $7.7 trillion in treasury bonds, 3.1 or 3.3 trillion at the central bank level. If it comes to a choice of freezing, starving, or selling treasuries and sending rates higher for the world, they will do the latter over and over till their hands bleed. And that's what we were seeing happen in August and September, or excuse me, September in particular started to get more aggressive. We've been seeing it all year. I think it's going to keep happening. And that's a really bad, basically, higher energy is really bad for risk. It's really bad for bonds. It's really good for the dollar. And again, eventually, I think it's probably keeps gold bid at the very least relative to what gold should be doing with real rates rising that fast. But ultimately, I think it's going to be good for gold nominally. I think gold goes up with oil as this situation continues to evolve.
You know, I think one of the asset classes that has some of the most bullish fundamentals. No one talks about it. You talk about people not wanting to freeze or starve, and when I look at grain markets, they look like they've just corrected from the invasion. And if you look at how production is down 10 tons because of the warm summer in Europe and India, it's going to be down 30 tons in the Russia, Ukraine grain belts next year because of the war and not being able to plant. To me, it looks like this could really be something that people could use as a hedge as well, besides energy. In fact, I think the fundamentals are stronger in the grain market than they are. I don't like to have a bull market in grains, but I think agricultural commodities are something that, even if the Fed wants to continue to tighten, does not have as much influence over. What do you think about that?
I think that's right. I mean, for me, we've been telling clients I like energy, and I broadly define energy. It's not just fossil fuels. It's also uranium. It's also ag grains. Ag grains are simply, when you really look at what soybean, corn, wheat are, all they are is seed, sunlight, water, fossil fuels, you know, to vastly oversimplify. And if you start taking away or making more expensive the fossil fuels, if you start restricting water, you're going to make these grains more expensive. And like you, as a human being, I'm well aware of the implications of that across the emerging markets. That just, again, in the same way oil does, that reverberates back, unfortunately, into treasury markets, risk markets, et cetera, which is people need to eat. And
I mean, last time we had a situation like this, I believe it was 2010, 2011, we had the Arab Spring. So, you know, it can create a lot of geo unrest when your population gets hungry. And China's been buying wheat for years and stockpiling it. They saw it coming. Anything else you want to cover, Luke? I mean, I really think that people should follow you and consider FFTT. And you know, this is really you know, your work is great, the testimonials are great. Going into year end, what is the most important advice you could give people between now and 2023? There's only a couple months left.
I think it is to continue to stay unlevered and keep a very elevated cash position
with some physical metals.
with some physical metals. To me, I personally, I'm very, I don't trade, so I make more strategic adjustments, and it's, we've been saying since April really that, people managing a monthly book, I would be in almost all cash.
Okay.
I'm not a big shorting guy, given the central bank regime we've been in. That's been wrong this year. That's obviously been wrong, in terms of shorting equity markets and emerging markets, what have you. But for traders, I think it's critical to understand where we are in the big picture, which is we are coming to we're living through the first bursting global sovereign debt bubble in 100 years. And as that happens, it becomes extraordinarily volatile. It becomes extraordinarily political. And so I think it's important to understand it's going to be, that's why I say unlevered, nimble, don't get too far out over your skis. I mean, I have a chart that I put up from my friend Dan Oliver at Mermercan Capital. It shows the price of gold in German Reichsmarks as Weimar Germany was hyperinflating. Gold was going to $1 trillion. With that said, from 1918 to 1922, as gold went to $1 trillion Reichsmarks, went to, the Reichsmark collapsed. There were 4 or 5 different instances where people said, oh, the Reichsmark's going to run QT. They're going to implement austerity. They're going to strengthen the Reichsmark. People were selling gold multiple times to buy Reichsmarks from 1918 to 1922. So that if you were levered long gold, which if you look at that chart without looking at the ups and downs, you go, oh, this is easy. I borrow a bunch of money, I buy a bunch of gold goes to $1 trillion, I trade it all out. The reality of it was that if you were levered long gold in Weimar Germany from 1919 to 1922, you lost all of your money 4 different times because you got carried out on your shield because it's Bitcoin. Right? Hey, I'm going to buy, the US has a fiscal problem. I'm going to be levered long Bitcoin. Great. 70,000, 17,000. Now all your capital's gone. You're done. That's what I mean. Why I think unlevered is so important. This is a once in 100 year, very volatile political situation that I think it's important traders understand that as they operate in these markets.
Okay, so 100 years ago, we know about the hyperinflation in Germany. Where was the sovereign debt crisis? Did the U.S. have one back then? Was it global? And how did it play out? And how did we come out of it?
It was global. If you look, the 6 biggest industrial powers: U.S., U.K., Germany, France, Japan, Russia. The sovereign debt crisis was ultimately the cost of World War I. We sat down. The Germans, we had made the Germans pay, and then the Germans had to pay the French and the UK. We demanded that the UK and the French repay us for the money we loaned them. How it worked out was Germany hyperinflated, Russia hyperinflated within a couple years after the war. The other 4 all saw their sovereign debt collapse against gold over the ensuing 10 to 12 years by 75 to 100%. So basically, inflation and currency devaluations, many multiple times, some just really big all at once. UK devalued the pound, I want to say 60 or 70% against gold in 31. US obviously did so in 33, 75%. Okay. So it took
20 years. It took World War II for us to come out. Well, we had the Roaring 20s. So
yeah, you had the Roaring 20s, and you had, there was, there were ups and downs, but even within that, it's the last thing you wanted to own was sovereign bonds. Debt. Yeah, bonds just get, on a real basis, they got killed. And that's, I think we're starting that process again. It's not to say there won't be counter trades, but you can see why it happens. Is what's, for me, the bull case on bonds is that the Fed comes in and prints more money and caps the yield, starts buying them again. Well, you could make some money on bonds nominally if they do that. But there's way better expressions of that trade, right? Bitcoin's going to moon, gold's going to go up, stocks are going to go up, commodities are going to go up, much more than bonds will. So you're into this, I think the other side of, 40 years, bonds won no matter what, basically. And, we're sort of 9-10 months into bonds losing no matter what. And I think it's going to last longer than that, unfortunately, all else equal.
What a great time to have you, and thanks for cheering us up for the upcoming holidays, Luke. You know, I mean, you're a straight shooter, and everyone can follow Luke at Luke Gromen, and he's a very important part of my intelligence gathering, and consider subscribing to FFTT and check out Luke's writings and his YouTubes. You have a YouTube channel where you go over things as well every week, right, Luke?
Yeah, every other week or every third week. Yeah, we do a 10 or 12-minute update that we get a lot of good feedback on. So you can find that on YouTube.
Luke, thanks for being a watchman for all of us in these, you know, I've heard an unprecedented amount of times in the last few months.
Yeah,
so,
there's some crazy things happening for sure.
Yeah, we need people like you to, you know, keep an eyeball on what's happening so that we're not wrong-footed at the worst time. We appreciate your work. All right, Luke Gromen, everybody. Thank you, buddy.
Thanks, Dan. Yep, thank you.
All right, so that's a wrap. My Trading Warrior brothers and sisters, and you could join the team in 18 minutes on the Morning Edge. Hope you enjoyed, Luke. See you guys tomorrow. And don't just count your pips, count your blessings. You guys have something to say? Yeah, Luke's great, isn't he? Yeah, okay. Well, everyone have a great trading day. We'll see you tomorrow for the big number. It's going to be a critical day. You ever hear that before? Every day is critical. Tomorrow will be critical too. Adios.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.